Good afternoon and welcome to MFCorner. I'm Sumaira Abdi. There are two important issues that we're discussing on MFCorner this afternoon. The first, of course, is international funds. How much global exposure does your portfolio need? We have Prableen Bajpai of FinFix Research who's joining in to explain that concept to us. And a little later on the show, we're also going to tell you about how you can offset the losses on your mutual fund portfolio against the taxation that you have to fulfill on the gains that you make. That is coming up a little later with Somil Shah, an independent tax expert. But first, let's talk about international funds. Prableen Bajpai is with us now. Hi, Prableen. Good afternoon. So first, just to talk about international funds, they have been catching the fancy of investors over the last 1 year. They've more than doubled in terms of the assets that they're managing. But it's still a very, very small portion of the pie that mutual funds are managing. Why are international funds, not more prevalent in people's portfolios? And is it, how much does a person even need to invest in it? How much should they be a part of somebody's portfolio?
Hi, Smira. Thanks for having me. So I think let's start with exploring, how the trends have been. Of course, when we talk about any investment opportunity, it is not bound by borders and it's across geographies. If you look at the US investor base, data suggests that they have been prudent and smart enough with the options available to them for investment to take advantage of the growth that, has been there in the emerging markets or certain regions, globally. While in India, this concept has been relatively new. We only had these funds started coming in like 2010, 2012. Only one or two funds were, available before that. So it's not a very, old concept. It's a new concept. And another reason for this is, the equity participation as it is in the Indian markets is much lesser, when we compare to any other mature markets like the US. So I think the first step has been to get people to invest in Indian equities. And then the next step is, where they actually realize that there is, merit in going overseas, investing across geographies. And I think with the rising awareness, that has begun to happen.
So, Prableen, is it that a person who's probably looking to spend in dollars later, maybe for a vacation or, a child's education, is that the only person who needs to invest in international funds, or does just about everybody, need to own a portion of it to sort of hedge the rest of it?
So, Sumira, when we talk about, the dollar part, see, that can be in your favor and it can go against you as well. So that cannot be the criteria while you decide if you want international fund in your portfolio or not. If you look at the Indian markets and the markets globally, they've historically had a low correlation. And that is the first point which, solidifies the advantage of going and investing in markets abroad. So why, in the first place, a person should be adding a global fund to his portfolio is, to gain from the benefit of diversification that these funds can give them. If we just look during the time period, about 15-year data, I'd like to just point out, early 2005 to 2020, the correlation between Nifty and S&P 500, as well as Nasdaq 100, was just about 0.2%, 0.2%. Which is a low correlation, and that is where the merit is. And the second is the growth opportunity that these markets can give us. When we are investing domestically in our markets, we are restricted to HDFCs, ICICI, Infosys, such names. We don't get to have exposure to companies like Microsoft, Apple, Amazon, Netflix, Pepsi, Coca-Cola. And that's where, you're adding true diversification to your portfolio. So it is not for somebody just who's looking to, maybe hedge against dollar. That can go against someone as well.
Okay, so basically, what I'm trying to understand is that, who needs it? For somebody who's watching the show right now, they should be able to go back with the takeaway of whether or not they need to add an international fund. So therefore, would it be a more savvy investor, or just about every retail investor could allocate, say, 5 to 10% into an international fund?
Yeah, Smera, I feel somebody who is investing in the Indian equity markets, just the way we have exposure to mid cap, small cap, large cap, I feel international funds can be another segment in which investors can definitely have exposure. So within the equity part of their portfolios, I feel anywhere between 10 to 20% is a healthy, percentage that they can have internationally. Also because it comes with the benefit of a dollar hedge that you just mentioned, that somebody's child probably going to study abroad. In the last 10 years, 2010 to 2020, rupee was around 46 against USD in about 2010, and now it is at about 75. So you see the depreciation there. And whenever there is depreciation in INR against the USD, these funds stand to benefit.
Okay, but Prableen, by and large, the international funds that we have follow the fund of funds route, right? So isn't that therefore increasing the amount that you're paying out as fees? And also, what about the taxation on these funds?
So yeah, primarily these funds do invest as a FOF, which is a fund of fund, wherein they are buying the units, or they are investing through another mutual fund. But Sumera, I did study the expense ratios for about 37 of these funds, which are there in the category. And the expense ratios hover somewhere starting from 0.5 to about, and it goes up to 2.5%. So, which is quite in line with what we have in the other schemes in the Indian space, in equity space. Having said that, the expense ratios for some of these funds are high also because the AUM that they hold is very, very small. So the fund with the highest AUM within this category is just about 1,500 crore, followed by about 700 and 600, 500 crore fund, and rest of them, many of them in fact in just double digits as well. And if we talk about the taxation part, that is where it differs from how they are from the Indian equities. So any investment which is in a global fund, in an international mutual fund, is treated as a taxation which is equivalent to debt. So if you're investing for a time horizon of less than 3 years and redeeming, so whatever gains you have will be added to your income and taxed as per your slab. And if you're holding it for a 3-year period, then you can avail the benefit of indexation where you are taxed at 20%.
Okay, so Prableen, just one final question to you now. You mentioned, I mean, of course, the industry size itself is just about 5,000 odd crores, or a little shy of that. And within that, the largest fund itself is just 1,500 crores, right? So if somebody wants to go out and invest today in an international fund, what should he look for in, when they're comparing schemes? Should he go with just the biggest fund in the category because that might seem the safest, and because that fund manager would be managing about 1,500 crores, therefore you'd expect that he'd do a lot more research than the person who has just about 50 crores invested in this?
So out of the 37 funds, Sumera, which the number that I told, some of them are thematic funds, which invest globally in a certain theme. It can be gold mining. We have a fund from DSP. It can be into broader mining companies. It can be into a specific country like Brazil and China. We have a fund from Edelweiss, which is taking exposure to China. There are funds from HSBC, which is offering you exposure to Brazil. So I would say somebody who's entering these markets, is wanting to step out into the global markets for the first time should go with the largest economy. So you can stick with US-based fund. And I think within US, just taking a fund which is, investing in one of the bigger indices there, I think that should be a safe bet. So that one can have the basic understanding and gradually maybe, move on to investing into something else. But I feel as a country, America, US can be the first choice, and taking a broader index there.
All right, so like every other category, no two funds are created equal, even in the international fund space. But like Prableen says, perhaps for starters, you might want to stick with the one that has the biggest size and also exposure directly to the US. Prableen, thanks very much for joining in and for breaking down this concept for our viewers. We're going to take a very quick break, but as we do that, I want to leave you with some thoughts from the AMFI CEO NS Venkatesh, and particularly on, there were some doubts raised that there was a discrepancy in the reporting of the total debt inflows number for this month. The number which AMFI had reported on the 1st of June was north of 90,000 crores, while the number that we got yesterday was shy of 70,000 odd crores. So here's Mr. Venkatesh explaining why this discrepancy has come about, and he's also promised that this is something that will be corrected in the next month.
Essentially, I would say that it is an RTA-related issue. So RTAs are reporting in different formats for different purposes. So I think we have told the RTAs to actually harmonize it and come out with the right numbers, so that at least we don't give two different numbers for the same date. What had happened was the hybrid schemes, when there is debt, that some people report, some RTAs report, some RTAs don't report. So we have told them to harmonize everything and come up with the right numbers, so that at least these sort of glitches don't happen. The format that has been published for the monthly number is a different format from the format in which RTAs reported the daily flows. Essentially, the inter-scheme transfers, whatever has happened within the SEBI regulations only. So it is not as if there is any violations of any SEBI regulations. So to that much extent, the industry is following all the regulatory prescriptions made by the regulator. As we go along, we definitely will learn new things after each event happens. So here, if we want to merge between a duration and a credit risk, that can happen over a period of time, in the sense that based on discussions with the regulator, it can happen. The duration signifies the interest rate risk, that sort of thing, whereas the credit risk is a totally different factor. So to that much extent, if you have to merge both these things and then put out something, then that could be a guidance coming out from the regulator, and then maybe the industry will follow that.
Welcome back. You're watching MF Corner. So far, we've spoken about international funds, who needs to invest in them, how much should you invest in them, and how do you select the scheme that's best for you. But now let's talk about another important subject, and this is something that retail investors often overlook, which is that the losses that are suffered in your MF portfolio can actually be offset against the taxation that you have to pay on the gains that you make. Now, this is both for equity and debt. How do you do it? For how long can you do it? So we have an expert joining in. Saumil Shah, who's a senior chartered accountant and an independent tax expert, joins in now. Hi, Saumil. Good afternoon. I'll get to the part of offsetting the tax bit a little later. First, can you start off by telling us exactly what is the taxation on the various segments, and then we'll take it from there.
Sure. Thanks for having me on the show. Essentially, we are talking about three levels or three streams of income from a mutual fund. One is the interest income, second is the dividend income, and third is the capital gains. So dividend income now is taxable in the hands of the recipient after 31st March 2020. Before that, it wasn't taxable in the hands of the recipient. Interest income is also taxable in the hands of the recipient as per the normal income tax slabs. However, capital gains actually arise on redemption or on sale of the mutual funds. And that also depends on whether the mutual fund is equity-oriented mutual fund or non-equity-oriented mutual fund. And within that, an equity-oriented mutual fund on redemption, when a person earns capital gains, is either taxed at 10% or 15%. And in the case of non-equity oriented mutual fund, which is essentially debt fund, a person has to pay tax at 20% or tax at normal rates, depending on the holding period.
Okay, this holding period is what exactly?
So the holding period in case of equity-oriented mutual fund is 12 months. So if a person redeems or sells his mutual fund in less than 12 months, then any capital gains or loss is deemed to be short-term in nature. And in case of non-equity oriented mutual fund, the holding period is 3 years. So if a person who sells any debt-oriented mutual fund for a period of less than 36 months, then any capital gains or capital loss that he earns is short-term in nature, and anything more than 36 months is long-term in nature. So a short-term equity-oriented mutual fund is taxed at 15%, whereas long-term equity-oriented mutual fund is taxed at 10%. Short-term debt-oriented mutual fund is taxed at normal tax rates, and a long-term debt-oriented mutual fund is taxed at 20%. So it's quite complex. You need to have a tabular matrix.
Okay, fair enough. And therefore, for SIP, it would be like if you've invested over a period of a year, it would be the first month when it completes 12 months and so on and so forth. But Saumil, tell us, how do you actually mitigate the tax implication?
So the only way you can mitigate, or there are two ways in which you can mitigate. One is that if you have any business loss or any capital loss, then you can offset it against the capital gains. Or if you've earned capital gains and the recipient or the person who's earned capital gains is willing to invest that money in a residential property, then the amount of investment that he does in the residential property is exempted from capital gains proportionately. And the time period for making that investment, if it's a under construction property, then the time period is 2 years. So within 2 years of earning that capital gains, he has to make that investment. But if he's actually constructing a house or a residential property for himself, then the time period is under the Act is given for 3 years. So that's the only possible way in which a person can mitigate his capital gains tax.
Okay, Saumil, just a quick follow-up here. The NHAI bonds are not, investing in that would not earn you the same treatment as investing in residential property?
Not anymore now. So earlier that...
All right, so now let's come to the meat of the matter.
Yeah.
Okay, I take your point. Now the one that I want to talk to you about, which is that how do you offset these losses against the tax on gains? Is there a way to do it, and for how long can a person carry forward those losses?
So it's quite complicated. Unfortunately, capital losses can be offset only against capital gains. You can't offset capital loss against business income or against any other income. Now, within that also, you have to determine whether the capital loss is short-term in nature or is long-term in nature. So a short-term capital loss can be used to adjust short-term capital gains and long-term capital gains. Whereas a long-term capital loss cannot be used to set off short-term capital gains, but it can only be used to set off long-term capital gains. So the logic out here is that the higher tax benefit that you get, you can offset that against the lower taxable income. Because short-term capital gains is taxed at a higher rate than long-term capital gains, short-term capital loss is allowed to be adjusted against long-term capital gains, but not vice versa. And any excess of long-term capital loss or short-term capital loss can be carried forward for a period of 8 years, and the same can be adjusted, as I said, against either short-term can be adjusted against either short-term gains or long-term gains, whereas long-term capital loss can only be adjusted against long-term capital gains in subsequent 8 years. After 8 years, the losses lapse.
Okay. Okay, so basically if you had made 100 rupees of losses and you're adjusting 50 rupees against the gains this year, the rest of the 50, the balance, can be carried forward for a maximum of 8 years from the date of incurring that loss. What about loss in business income? That can be adjusted also against capital gains tax?
That's right. So that goes with the same logic that the business income is taxed at the maximum marginal rate, and therefore the losses arising on that business can be used to offset either long-term capital gains or short-term capital gains. So a business or loss on business can be used to offset short-term capital gains or long-term capital gains. However, any carry forward business loss in next 8 subsequent years can be used only to set off only against business profit and not against any capital gains. So these are the restrictions under law.
Okay. Saumil, thanks very much. Taxation for most is quite a confusing subject, but thanks very much for breaking it down and making it easy for our viewers to understand. Thanks much. With that, we'll wrap up then on MF Corner, but do stay tuned. The market action continues with CNBC-TV18.